How's it going, guys? Welcome back to mentfx. And have you ever asked yourself why it is that when you have a market unfolding like this and you're range bound in some cases between a very low time frame and higher time frame areas, that prices do a lot of this type of stuff and give you tons of things like of this nature where you're looking for shifts and re-entries all the way back down and then new entries to take yourself higher? Why is it that we are able to wait for confirmation absolutely everywhere? And is this type of thing going to be around forever? And how and why is it important that you do continue to look for confirmation and refine the way you look for confirmation? Now, for a lot of you that have been trading smart money for a while, a lot of you might still be looking at it from a retail standpoint, which is having a certain area, waiting for price to come in there, give you a setup, and then take it lower without understanding why it is that this right here and this waiting for a setup actually works. The reason that waiting for an actual setup, so in this case right here, right, we actually had an area drawn out right here at a certain time. I think it was on a 15-minute time frame, I believe, that I was trading this. Maybe a little bit higher. Yeah, it was a 15-minute. It was the last buy to sell as this price broke down. And as it came back up here, right, we could have, as you all know, been sellers right at that specific area, right, with the last buy to sell, take that lower with the stop loss here, understanding that we're targeting the lows inside of here and have prices come into there relatively easily. About 1 to 4.79. Now, on the other hand, what we actually ended up doing in this case is we went down to a lower time frame, and as price came into that area, I think I was on a 5-minute time frame actually. Yeah. As price came into that area, we waited for Wyckoff to happen and waited for the confirmations with liquidity being created right before the area, as you can see, right? The AR, the ST, testing the supply zones in there, creating trend lines, whatever you want to call them, sign of weaknesses, up thrusts, other sign of weaknesses, creating more liquidity, right? Miniature up thrust, a sign of weakness again. Then we finally have the UTAD breaking higher than all this and the real breakdowns that move price lower. And at this specific point, we use this overall schematic, which we then refine to an actual buy to sell on a higher time frame. In this case, that buy to sell being the actual area right here, right? This last buy to sell candle. As you can see, we actually went to refine a little bit more. If you went to the 30-minute time frame on here, you'll then see the overall buy to sell with the last wick up here, right? And then all we did is we just took the 50% of that from the top to bottom, and that's where our overall entry for this place was. Now, why is it that this works, and why is it that we had waited for this to actually occur here? And why is it that price actually then continued to make its way all the way back up here before moving lower? Well, the main thing for that is because structure, the way you have been taught it, whether it's through smart money or retail, is for the most part very wrong. Structure doesn't develop just because there's lower highs and lower lows. That's partly part of structure and how you will be able to signify order flow and understand where to get involved. But structure also is a variant of understanding which lows are going to be taken, which lows are going to be held, why they're going to be held, why they're going to be taken, where liquidity is being created, how liquidity is going to be manipulated, and where the real entry is going to happen. So for instance, the reason I was so confident about this entry, even after this whole breakdown here and using this area, is because we saw this stuff occur right here. Wyckoff began to occur before coming to grab the last people that were trying to sell the area here, and then continued lower, right? So even though there were a lot of retail or dumb money or weaker hands interested in being sellers on this market and knowing that it was going to actually break down lower, they were getting involved here, 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 and here, without recognizing that price has had higher areas to go and mitigate before lower prices were met. Now, the reason I bring this up is because the main rule that I want to kind of talk about in a specific video is the fact that smart money or strong hands in this market always show you their cards before they actually make their move. Now, that's not always going to be the case, but you will be able to see the footprints of what they do in the market and how they move the market, and they will show you where they want to take the market if you give them the chance to. If you have the patience to wait and let them play it out for you, you're going to know more likely than not, probability wise, which way they're going to take the market using these areas, right? So for instance, if we just delete some of this stuff on here very quickly, there we go, and we go back to the actual 15-minute or 30-minute, what was it on? What was the sell on right here? Yeah, so as you can see, there was this last buy before the sell that occurred right here. Now, with the rule of 30, as you all understand from the last video, if you haven't seen it, make sure you watch it. Using the rule of 30, you understand that the best confirmations for the Wyckoff in here would more likely than not be on the 1-minute time frame. Okay, now First of all, why is it that we go to the 1 minute time frame? Why do we give it ample time to play out in this specific area? So in this case, I think I actually used a 5 minute to confirm this, just because it was better in this case. It's not always going to be perfect with the rule of 30, but the rule of 30 is going to be very, very helpful for understanding how price is delivered. Why is it that we go and confirm areas like this? And why is it that we can expect that if prices are to confirm like this and then move lower, that we can then expect them to come back up, give you entries, and then continue lower? So we also see that happen on the gold trades that we had throughout the week, right? You have an area that, again, I mean, it's literally the exact same setup. You have an area, leaving behind allows buy to sell, going to confirm that buy to sell on a lower time frame inside of here, and seeing, even though it's a 5 minutes, seeing that lower time frame give you the exact same thing of transfer of buys to sells. Now, why will this specific pattern, or in this case Wyckoff, occur to all these areas? Well, for a multitude of reasons actually, but the main reason, or the main two reasons, being that in a specific area of supply or demand. So when we talk about that, we're talking about unmitigated areas of supply and demand like so, right? Unmitigated areas of supply and demand like this. Unmitigated areas of supply and demand like this, right? The reason that a lot of these areas right here form is because on the way down in a markdown, right, when price is coming lower, we have mini liquidity grabs against the weak hands. And what I mean by that is there are weak sellers in this that are getting involved all the way through. Many weak people getting in. And as these weak people get in and prices break down even ever so slightly, because they're watching lower time frame charts as well, people begin to move their stop losses to these highs here, to these highs here, and these moves against the trend, right, that come down lower after, are made by smart money. And what's actually happening in smart money is buying up hard into those stops, grabbing those stops for new entries, and continuing lower. Buying up hard to take, as you can see this wick, buying up hard again to get rid and mitigate some of the areas that they had to sacrifice prices into, because when they buy, they're in buy positions and they need to exit them. So when they come back up, they mitigate those and continue lower. Come back up, mitigate those, continue lower. Come back up, come lower, create liquidity, and what happens? More people, dumb money, or people that are not as strong or committed to this or are moving their stop aggressively, are taken out by the strong hands with the wick here that also mitigates their previous orders in here and then continues lower. And this will happen over and over again. So when this happens and you're left behind with areas like such that are left unmitigated, what you can assume more often than not is that there are orders in that area that are still left that need to be taken. So in the future, when price gets here, it can either come in and mitigate for a while, then continue way lower, or it can mitigate if it has a larger prerogative to go higher, to come meet a demand zone that was formed along the way up, right, in here for instance, and continue higher. But before it does that, inside of there, even if you were to zoom in on that price action, you're more likely than not going to see this happen again. Now, the reason this always happens isn't because it's just some kind of fun little pattern that we form. It's because it's literally showing you what is happening when, for instance, there's a markdown and people are still trying to sell into or move their stops. When we have something like that occur, what's actually going on is there are people preemptively entering the market, looking for sells, trying to get into the big move, expecting this to happen, expecting this to happen, expecting this to happen, without recognizing that we're undergoing an area where we're transferring all those orders of people that can't hold that well into the smart money hands, which is why Wyckoff occurs in areas like that. And again, we're gonna have a Wyckoff video that comes out a little bit later on all this, but you need to understand that the reason that we undergo all these phases of buying climax, AR, ST, sign of weakness, UT, UTAD, breakdown, test, is because it signifies the transfer of all the weak hands in the market, whether that be retail traders, whether that be smaller banks, retail banks, whether that be hedgers or players that are hedging in the market very short term, or even players that are hedging the market very long term. This will be seen across all time frames, because emotionally, when you see certain price movement, it is going to make you do a number of things. And if you don't understand what I mean by that, imagine back to when you were watching a 1 minute or a 5 minute chart, just trading it right back and forth, kind of trying to scalp it, and watching that candle form and seeing that candle, you know, make a big move up, come back down, right? Make a big move up, come back down, like as the candle is forming. And as that happens, you begin to believe a certain thing about the way that price wants to go because of the way that candle is forming, right? And then it begins, maybe as it does this, right, goes away, does this, goes away. You begin to buy into it, thinking that it wants to like make that break. And then all of a sudden, it breaks down way lower. Why does that happen? Because when it's doing these mini moves, up and down, up and down, up and down, up and down, the real moves in here, if you were to zoom in on them, which is why I use the second charts or go even lower, because like I said, the market's fractal. If you were to zoom in on this move of up and down, up and down, up and down, you would more likely than not see something like this. Okay, and if you were to zoom in on that and see this, you would know exactly what was happening. And what was happening here is there was another transfer of those really weak hands that weren't able to sustain the movement of seeing this happen over and over again, to strong hands that had made that happen to continue price in a given direction. Which is again why, if we go back to our specific example on Australian dollar, US dollar that I was looking at this week, right? Which is why when we had this area, prices came into it and didn't just reject. Now, sometimes that will happen, but what will happen is even if you zoomed in on the rejection, you'd usually see something of this sort occur because there's always a transfer of weak to strong hands. And the reason, and because there's a transfer of weak to strong hands, there is basically smart money showing you their cards before the play is made. Okay, so smart money is showing you that liquidity is created here and there's going to be impulses away. Smart money is showing you that they're liquidating those people and selling off hard. Smart money is then showing you that it's coming to mitigate those positions and selling off hard again. Smart money is then showing you that as this begins to break structure and more retail traders or dumb money or weak hands are entering into sells and moving their stops aggressively to either here, 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 because this is again on lower time frames, you're going to see something like this and people are going to be moving their stops along the way. So when you see this come up again, right, create a little bit of liquidity again before coming down, right? Look at this. If you were to zoom in on this and actually study the price action from a standpoint of retail or emotional trading, this engulfing candle right here, which engulfs the entire thing, would in some cases, for a lot of people, be a clear selling sign. And then we have the final real grab of the last bit of weak hands in this market that had moved their stops very aggressively. And those weak hands are then entered into the strong hands and moved away aggressively and fast. Now, if you understand that time frames are not really there for the sake of time, but actually exist there for the sake of seeing price, you'll notice that as we move through our time frames, you see the exact areas left behind where mitigation still needs to occur. Right, so what I mean by that is if we go to 30-minute, as you saw here, you have these buys to sells where mitigation inside of them have not occurred yet. So when we go and we refine that, or we take the 50% of that overall area, like so, right? As you can see, remember this was the fib. So if I was to delete that right now and just show you a fib right now with a 50% line on there, that's where the entry was. You are placing entries there under the understanding that one, we've liquidated people in the past, and we've traded from an area where we're mitigating previous buy to sells that we put in as an institution. And if those are to be mitigated and there is a transfer from the weak to the strong hands, then more likely than not, you're going to see prices continue in those given directions if you are given the confirmation of that transfer again. Right? So the cool thing about being a retail trader or being a trader in this market that does not have billions of dollars is you are free to wait for and be patient for the best entry. And the reason you can do that is because smart money or strong hands need to come back, one, for the mitigation of prior orders are also going to be negative for a long time and they don't always want to do that. Or two, you can see them liquidating other people and trapping other people in the move. So when this happens right here and they trap all these people and then they move away hard, you know that if prices to ever come back up here, it's more so for the mitigation of those buys to sells and trapping all these retail or dumb hands before taking price lower rather than coming up here to continue higher. Right? You have to ask yourself about the story being laid out to you by smart money and ask yourself what smart money wants to do. And this will occur to across every single time frame. And what I mean by that is let's go to Euro US dollar for just 1 second for the sake of explaining this. This is a 14-minute video already, so I'm going to kind of cut this out soon. But if you take a look at this monthly chart right here, right? And we take a look, for instance, let's look at something that's relatively simple to see. Let's look at this last buy to sell that occurs right here, okay? So this last buy to sell right here. You have a buy to sell right here. This buy to sell, leaving behind what? Imbalance, showing you that there was some kind of participation on behalf of smart money that came to mitigate older orders in here before coming lower. Now, as it did that, again, it came into this area right here, which at that point, if you then go and look at a daily time frame, again, rule of 30, if you haven't seen the rule of 30 video, make sure you go find that on my channel and check that out. But if you are to go to the rule of 30 video and then check the daily chart on here, what you'll notice is you have this same transfer, right? You have prices come back into these areas, and just because they came back doesn't mean they instantly have to go higher. Why? Because they, one, need to mitigate a number of a number of positions, and two, they need to use the weak hands in this system, whether that be retail, whether that be retail banks, whether that be commercial banks, other companies that are hedging, hedging companies that are afraid or get more emotional, anything of that nature, right? To liquidate those specific people, right? With things like this, the equal lows, the liquidations of those equal lows, have people get into these buys, liquidation of those, and then finally, as they've liquidated everybody in this market that had already expected it to be bullish, right? And have mitigated all their prior positions available back all the way over here. So again, this is an example of, it can take time. This is from 2006 and the mitigation of it was in 2010. Those orders still exist, right? The algorithm still knows that there's orders there that need to be closed. There's fair price that needs to be met. And as a result, we move from those areas and expect higher prices. Now, as price came from there, as you can see, it made a markup all the way up into that area like we said it would. And take a look at what it does when it gets here. Not only does it just get here, right? But as it gets there, what does it do? On the way, it begins to create highs and move, it begins to create highs right here and move away from those highs, getting people into the market, giving them the expectation that they can begin to expect sells, right? People are already expecting sells here, liquidating them. People are trying to sell again, liquidating them. And now, or even right here, these little moves right here are people trying to expect sells and then liquidating the last bit of sells, the transfer of all the weak hands that have been in this market to all the strong hands before the real down move begins. And even when the real down move begins, notice what happens. As structure begins to shift, right? It doesn't just break down. This is a daily chart, remember that. Instead, what does it do? It creates, again, liquidity along the way, equal highs, more highs here on lower time frames, because remember, on lower time frames, inside of even this price action, there's a ton of liquidity and trend lines and channels and all that fun shit being created, right? So as a result, when they've created all that, what can they do? Now they have a prerogative to take buys back up into their previous areas where they bought to sell, take out some of those positions, mitigate them all so they don't have to be at a loss, and then continue on their move down. And before that move down actually occurs, notice what occurs in these areas, right? We have these buy to sells, moves away, creates more highs. Like having more people believe in the structural thing of plays, right? Believing in the lower low, lower low, lower high, lower low, lower high, expecting these lower lows and lower highs to hold without recognizing that structure isn't a candlestick based structure, which is something we talk about in the mentorship. And if you want to join the mentorship, this is the only site that is ever going to be available on. But understanding that structure isn't built through candlesticks, structure is built through order flow. And if there is liquidity that is to be grabbed, then it will be grabbed before continuing on an institutional structural play in a given direction. So again, you can go on lower time frames and look inside of these daily zones like this and understand that even in this daily zone, if we would go to a so a day is about 24 hours. So if you go to about a 1 hour chart in here or a little bit lower, 40 minutes, again, rule of 30, watch that video if you haven't seen it, you're going to see the same thing happen. You're going to see weak hands being liquidated, weak hands thinking it's going down in their little channel, getting liquidated, and those weak hands finally getting taken out of the market as the real down move begins. Real smart money traders, or the fish, which we are, right? We're just tiny, getting involved here, continuing lower. New structures put in place, people begin to believe what? Okay, we can aggressively move. Liquidations, equal highs. Liquidations, move down, take those people out, structural real breaks to the downside, and the mitigations of the areas that were buys to sells in the past to then continue on this real down move. And this will happen over and over again whenever Wyckoff happens. If Wyckoff is happening and it's happening in an area you're expecting it to mitigate at, then you know that you're letting smart money show you their hand, because smart money needs to show you what they want to do, because they're always getting into this market by manipulating others and taking out their own positions. So if you have an area where one, you're expecting them to close positions, and two, where they are liquidating other people and then shifting structure in certain directions, then you know that those last sells to buys are your perfect opportunities for entries to continue higher. Then you're going to create more places where people are going to get confused. On lower time frames, you're going to have more Wyckoffs, and you're going to continue higher. And the same thing is going to occur over and over and over again, nonstop in this market. Let smart money show you what they want to do with the market instead of trying to predict it randomly. Have a bias, have a preset idea of what they might do, confirm that idea with their real liquidations and transfer of weak hands into smart hand, into strong hands, and then be a participant of the mitigations of that play, because they have to come back for areas where they manipulated price because there's unclosed and unmitigated orders, as well as areas where they need to transfer all these orders. Okay, so thank you so much for watching, guys. I hope this made sense, and I'll see you guys in the next video.